On April 28, 2026, the United Arab Emirates announced its exit from OPEC, along with the broader OPEC Plus alliance. This chart shows the global distribution of proven oil reserves. The highlighted section represents OPEC's share, 80% of the world's total supply, allowing the group to dictate the cost of global energy for decades. The UAE is a cornerstone of this supply, pumping millions of barrels a day and investing heavily in new production capacity. Abu Dhabi joined the group in 1967, years before the UAE was even formed. They are walking away from an alliance that has historically managed trillions of dollars in global trade. This departure exposes a mathematical tension built into the foundation of every cartel, one where the incentive to cooperate is constantly undermined by the logic of the individual market. When developing nations founded OPEC in 1960, they sought to break the monopoly of Western oil companies and regain sovereign control over their resources. By 1973, they demonstrated the effectiveness of disunion. Coordinated production cuts led to a global supply crisis, with long lines and strict rationing at gas stations across the United States. A cartel functions by enforcing strict national production quotas. By intentionally restricting how much oil enters the market, the group ensures that global prices remain high. OPEC's global influence relies on collective restraint. The organization functions only if members agree to leave billions of dollars worth of oil buried in the ground to keep the market tight. This chart illustrates the prisoner's dilemma, explaining the friction between competing oil producers. Nations choose to restrict supply or pump freely. If both cooperate, both profit. But the highest payout occurs when others restrict supply, while you pump as much as you can. This incentive to cheat is constant. Between 1982 and 2009, OPEC members ignored their own production commitments 96% of the time. Today, the UAE is trying to monetize its newly expanded capacity of nearly 4 million barrels a day. However, Saudi Arabia, represented by Energy Minister Prince Abdulaziz bin Salman, has required strict production caps to fund its domestic agenda. Staying in the alliance forced the UAE to leave its own highly profitable assets untouched, effectively paying for the geopolitical ambitions of its neighbors. In 2024, that tension became visible. Analysts estimated the UAE was exceeding its assigned quota by roughly 700,000 barrels a day. Other members were also reaching their breaking point. Just a year earlier, Angola defected from the group over identical disputes regarding its production limits. Now that it is officially leaving, the UAE can gradually bring its additional production to the market, ignoring the restrictive quotas for the first time. For the UAE, the group's production caps had transformed into a financial prison, making an independent policy the only rational survival move. The decision is driven by the global energy transition, with forecasts suggesting that the demand for fossil fuels will reach an all-time high by 2030, before beginning to decline. The UAE's new strategy is to liquidate its highly cost-competitive oil reserves at maximum volume while a global market for those barrels still exists. By pumping without restrictions, the UAE makes it much harder for Saudi Arabia and Russia to manipulate the global price of oil through artificial scarcity. This creates an environment where independent nations are incentivized to drill at maximum speed, capturing maximum revenue before the transition to renewables takes hold. The UAE's departure marks the end of an era of managed supply, triggering an every nation for itself race to the bottom of the oil barrel.